Hey everyone, as you likely already know, last week the Federal Reserve raised the overnight rate by 25 basis points. And as I've shared in past videos, there's a lot more going on than just the number itself. Yes, the lower bound of the overnight rate is now 4.75%, the highest it's been since 2007, but in many ways, that's not really the most important thing. As I've frequently said, the rate itself is far less important than how quickly it's been moving. And from that standpoint, the 25 basis point move in March on top of the 25 basis point move in February, together with Chairman Powell's comments at the press conference, tells us that the monetary tightening cycle may be coming to a conclusion. That is the most important piece of information that came out of the March Fed meeting, in my opinion. I do have to say that we owe Silicon Valley Bank and Signature Bank thanks for helping the Federal Reserve come to this decision. The cracks in the banking system that led to those bank failures were critical to keeping the Federal Reserve from hitting the market with a 50 basis point move last week. That said, I believe the rate policies communicated by the Fed last week will affect the commercial real estate market in three ways. First, the flattening pace of rate increases and Chairman Powell's comments that the terminal Fed funds rate may be 5.1%, about 25 basis points from where we are today, brings increased clarity to the market. Banks don't have to build their rate structures based on the significant uncertainty of what the Fed might do next. If you think back to last summer when the Fed hit the market with 4 consecutive 75 basis point increases, it was very difficult for banks to set lending rates. Now, because the Fed's 2 consecutive 25 basis point increases and their signal that we're close to the end of the rate tightening cycle, banks will not have to be as conservative in their commercial real estate lending strategies. That means banks may begin to reduce the safety spread they added to their lending rates, and that could result in lower rates on commercial real estate loans going forward. As rates stabilize and hopefully come in a bit, the second major factor affecting commercial real estate could come into play. Investors will once again have greater clarity on the cost of debt capital, the interest rates they have to pay to borrow money for commercial real estate. Reduced uncertainty will enable investors to apply more specific underwriting to potential acquisitions. They won't have to worry that the interest rate on the deal they're working on may go up by 75 or 100 or 200 or 300 basis points while they're in the middle of the transaction. That will allow buyers to place stronger bids on properties they're trying to buy, and that will fuel the commercial real estate price discovery process. Finding the market clearing price is absolutely critical to the recovery of the commercial real estate investment market. Through price discovery, underwriting clarity will emerge, and that will lead to the narrowing of the expectation gap between buyers and sellers. The third way the Fed's movement will affect the commercial real estate market is much more general in nature. Quite frankly, the uncertainty surrounding what the Fed will do next has forced not only investors, but business leaders and consumers to adopt a much more cautious stance. As uncertainty surrounding interest rates and financial markets abates, a lot of decisions by business leaders and consumers and investors will be unlocked. That reduction of uncertainty and the decisions it will empower will support space demand for virtually every type of commercial real estate. The process may be an extended one, but at least many of the decisions that have been put on hold will be made, and the commercial real estate sector can once again move forward. Now, a lot of investors may get bogged down by how high the rates are compared to the last 10 years. But the 10-year Treasury is in the 3.5% range, about on par with where it was in 2010 and well below the long-term average. Prior to 2010, 3.5% would have been considered an incredibly low interest rate. We're still in a very low interest rate climate from a historical perspective, and if rates begin to stabilize, as I expect them to, investors should be able to make deals pencil. The investor community just needs to shift their focus from the short term to the bigger picture. Ultimately, real estate is a long-term investment, and making the best decisions requires the ability to keep your eyes on the horizon.